Good evening, TradingView. I hope everybody's enjoying their long weekend and enjoying the day off tomorrow, hopefully, unless you're trading futures, then yeah. So I'm jumping in to do some educational content. I haven't done any tutorials or educational stuff in a while, so I thought I would jump in and do one on managing risk. So how I'm going to present this is actually through a PowerPoint. So here we go. So managing risk. Um, in order to avoid us being like this guy here, there are some rules that I have developed for managing risk. And now these are applicable to me, and these are what I use, but I think that they can be generalized to many different people. So let's go over. There are 6 rules that I follow. The first being support and resistance. Second being having a thesis but maintaining an open mind. The third being having a target price in mind before you enter any type of trade on the day. Fourth being know your stop out before you enter your trade at all. Fifth being scale out along the way. And sixth being trail some of your position. So we're going to go over all of this with some examples. So if we look to the first one, which is support and resistance, there's no right or wrong way to draw support and resistance. Everybody's different. Some people use pivot points. They calculate pivot points. Some people draw support and resistance using daily candles, hourly candles, 2 hours, 30 minutes, whatever. Everybody uses their own different way. There's no right or wrong way to do it. Personally, I use the math-based approach for support and resistance, but there's no right or wrong way. You just need some type of reference point to add context to the chart. You can even use moving averages as your support and resistance. Everything is completely acceptable. It's whatever gives you the context to the chart. So if we look at this chart, this is SPY. These are my support and resistance. These are just calculated levels that my math-based indicators calculate for me. Some people will use, like I said, moving averages, pivot points. It doesn't really matter. It's not that important. You just need something, because without this, there's no context to the chart, right? You don't really know what the stock is doing, where it's going. You need that context, and support and resistance adds context for you to be comfortable in taking a position. The next is have a thesis and a target price. So having a thesis, I used to be kind of hit and miss on this. I used to think that it was better just to approach the day with no bias, but I've learned in the past year that that is not appropriate in times of heightened volatility, because the stock will pretend to do something that it's going to do the complete opposite of within an hour or two after open. So it's good to have a thesis and a target price, and it's good to have 2 potential target prices, one bullish and one bearish, because your thesis is likely going to be wrong at least 50% of the time. So you need to be able to quickly change your thesis to adopt to what you're seeing. So examples of using your strategy to develop a thesis is just by simply looking at the chart patterns and setups, looking at key supports and resistances. Are there breakouts? Are there no breakouts? Was there a failed breakout? These are all things that you can use to determine your thesis. And I'm going to show you an example with XOP, which is oil. So this was the chart that I saw a couple of days ago. I drew this triangle. I knew traditionally this is a bullish breakout, a bullish type pattern, but I knew that it could easily break down, especially under the current market. We are in a bear market, so you need to prepare for both situations. So the first thing I did was I drew my bullish target price, which was based just on um, support and resistance. You see this was an area of high resistance. And then on the off chance that this actually broke down, I drew a bearish target price. Again, just looking at support, okay? And then what happened? Well, it broke up and it hit the bullish target price, okay? So you see here, this would be where you entered because it's a confirmed breakup, and this would be where you take your profits. So the next one, and very importantly, but you need to know your stop outs. You need to have a stop out identified before you take the trade. Pretty much before you even contemplate your entry, you need to know your stop out. So you may be asking, like, how do I do that? Um, well, you need to take your thesis and you need to identify what is going to invalidate my thesis, right? So if I'm bullish today, what will the stock do to invalidate a bullish thesis? So if we look at an example, um, so for this particular day on SPY, I was bullish to this level here, the second bull target level, right? My ideal entry was this line here. So I could, of course, enter right here off open, but that would be poor risk management. Why? Because this would be my stop out, this line here. So if I entered here, right, I'm adding risk because in order for my thesis to be invalidated, I need this level to be broken. So I waited and we came down here, but we didn't come all the way down. It was too bullish. It broke back up, right? So once it broke back up, I entered there because I wasn't going to get my ideal entry point, but I still knew that this was going to be my stop out right down here, right? So once I entered there, then it was just a waiting game until we got to the target price, which it eventually did towards the end of the day. So really importantly, you should be scaling out along the way. And you should be doing this more so to hedge your position. I like to consider scaling out not as like locking in profits, but more as taking out an insurance policy without having to hedge with options. So I predominantly day trade shares. So I don't want to have to hedge day trades with like options. It's just ridiculous, right? So I look at scaling out along the way as just hedging my position. And I'm going to show you how it hedges. So if we look back at this example, we're entering here, right? And we're going to scale out half here at this next resistance level. Why are we doing that? Well, because, if you look, when you enter here, I'm scaling out at around $1.28 profits per share, okay? My stop out is around 98 cents away from my entry point. Now, if we do the math, if I scale out half there, it's about $32. I'm locking in on 50 shares. I usually trade much more than 50, but like a reasonable amount of shares would be 50. So I'm locking in $32. So if it does come back to my stop out, I'm only losing negative 98 cents per share. So it's a $24 loss on the remaining shares, but my net loss is only $8. My net loss is positive $8 because I locked in at the first resistance level. Had I not locked in at the first resistance level and the stock reversed against me, my net loss would have been negative $49. Okay. So this is why you need to scale out along the way, because I I never used to do this in like 2021, but this is something that I've started to do in 2022 and this year because it just locks in your profits. You need to ensure your position because the stock will reverse in a heartbeat, right? This is something I don't do enough, but you need to trail your target price. It goes without saying, once it hits your target price, take off another half and then trail the remaining amount of your position. Now, there are some considerations when day trading options. So options are prone to decay from choppy price action, which we are all used to from these past 2 years. My general recommendations for managing risk with options, and I really hate options. Like I said, I've been tending to just day trade shares more than options lately. But my general recommendations, and when I do day trade options, it's scalping the smaller moves. This doesn't expose you as much to theta decay from the choppy price action. take your profits at the next resistance level instead of waiting for the bigger move, because you're already leveraging your positions with options. You don't really need to wait for bigger moves like you do with shares. So when I'm in shares, I need to wait for the bigger move because I need to leverage myself a bit more. That I can't do that unless I'm trading options, because you're so leveraged with options. Just take just take the small move, okay? Like, this isn't the market for getting too greedy. And another way to hedge yourself is to go slightly out of the money with your strike and just to go a couple of days further out in your expiry. This will help with your theta decay, and it will help with the just premium decay from the choppy price action. So this is an example of my setup if I were to trade options. So it's the same day, but I use hourly levels because with options, I don't want to day trade them. I don't want to hold them for the day. It's too much. I'm risking too much by doing that. So I am going to break it down to hourly timeframes, and I'm going to get out in less than an hour of my trades. So for this example, the trade I would take would be just a simple bounce off of resistance or support, and I would take it at the next level. I'm not going to get greedy here with options, because if I'm here and it quickly reverses like this candle here, even if I entered here, this would immediately put me red on an option, because it's the massive spike in volatility will immediately destroy my premiums. So when I'm in options, I do not hold. I will get out as soon as my target price is hit, and I set my target prices for very realistic, very smaller positions. And that's it. And that's my dog. So yeah, that's it. That's all I have to. That's all I have to say. That's all I have to talk to you about. Hopefully, you found this informative. If you have any questions, leave them in the comments. And I hope you all found this interesting and helpful. Take care, everyone.